A stable job is supposed to reduce stress. That is the deal you accept. You give your time and get predictable deposits twice a month. The deposits look clean and consistent. The bank upgrades your credit limit within a year. The landlord approves a longer lease without hesitation. The car dealership stretches payments across 6 years. Each approval feels earned. Each contract feels manageable. The salary makes the numbers look safe. So you lock in better housing. You lock in newer transportation. You lock in recurring services that assume continuity. Nothing feels reckless because the income looks permanent. Your consistency becomes the foundation for larger fixed commitments. The system reads your stability as capacity. Then it builds obligations that expect it to continue. The deposit hits on schedule every 2 weeks. You check the number and feel calibrated. The timing rarely shifts. The amount rarely surprises. Your life begins to orbit that reliability. Rent withdraws 3 days later without friction. Utilities clear automatically in the background. Insurance premiums draft quietly each month. The car payment leaves on the 15th without fail. Student loans pull their portion on preset dates. Subscriptions stack in small, predictable amounts. Streaming, software, storage, memberships. Each one feels minor alone. Together, they form a floor. Groceries settle into a weekly average. Gas becomes a fixed line in your budget. Dining out stabilizes into a pattern. Nothing spikes hard enough to alarm you. Nothing drops low enough to question. The rhythm feels engineered for stability. You build your calendar around payroll cycles. You schedule bills against expected deposits. You plan trips based on accrued PTO. You finance devices because income looks continuous. You accept commitments that assume ongoing employment. The salary becomes the reference point for decisions. Predictability defines what feels reasonable. Stability feels responsible. Responsible feels mature. The routine reinforces itself. Smooth income creates smooth approvals. Smooth approvals invite longer contracts. Longer contracts increase baseline costs. The baseline quietly rises. The structure looks secure. It is orderly. It feels optimized. It feels earned. It feels under control. This structure feels rational. A stable income reduces uncertainty. Reduced uncertainty lowers anxiety. Lower anxiety improves decision quality. That is the logic. Predictable money allows long-term planning. Long-term planning signals adulthood. Fixed expenses feel like proof of progress. A nicer apartment reflects career momentum. A financed car reflects reliability. A longer lease reflects confidence. Recurring services reflect efficiency. Each commitment aligns with income stability. You are not overspending, you are matching structure to structure. Stable pay supports stable costs. That symmetry feels intelligent. Volatile income would require cash buffers. Volatile income would demand restraint. Volatile income would delay upgrades. Stability appears to remove those constraints. It feels like earned permission to expand. The raise justifies a higher baseline. The promotion justifies a larger contract. The bonus justifies a permanent upgrade. Each increase in pay normalizes a new level of obligation. The expansion feels proportional. It feels measured. It feels deserved. The system reinforces this belief constantly. Employers frame stability as security. Lenders frame debt as leverage. Real estate frames long leases as commitment. Culture frames consistency as maturity. You are taught that steady income should be fully utilized. Idle capacity looks inefficient. Unused credit looks wasteful. Cash sitting untouched looks unproductive. The message is subtle but constant. If income is stable, life should scale with it. That feels responsible. That feels optimized. That feels correct. The system is calibrated for predictable earners. Employers prefer workers who depend on steady pay. Dependence reduces turnover risk. Reduced turnover protects output stability. Stability protects revenue forecasts. Your consistency strengthens their planning models. In return, you receive scheduled deposits. Those deposits signal reliability to financial institutions. Reliability increases your credit score over time. A higher score lowers borrowing friction. Lower friction increases approval speed. Faster approvals increase contract size. The bank prefers long repayment timelines. Longer timelines increase total interest captured. Your stable paycheck supports those timelines. Landlords prefer tenants with verified income. Verified income reduces vacancy risk. Lower vacancy risk protects property cash flow. Property cash flow supports leveraged portfolios. Your employment stability strengthens someone else's asset structure. Insurance companies price around predictable profiles. Predictable profiles generate stable premiums. Stable premiums support actuarial forecasts. Every major institution favors consistent earners. Consistency feeds forecasting models. Forecasting models reward extended commitments. Extended commitments create recurring revenue streams. Your stability aligns perfectly with that architecture. The system does not resist your expansion, it accelerates it.